Good morning and welcome to the Oak Bloke um, Substack slash YouTube channel. Um, the empire expands. Who knows? So yeah, look, I just wanted to do a quick update on DGI9 and um, uh, clearly there's a little bit of reaction this morning to the news. But yeah, just wanted to uh, think about what the news could mean. So this is my recent article, and it was a slightly tongue-in-cheek. The chatosphere had spoken about how EMIC was doomed, and Aqua Comms was doomed, and Arqiva is doomed. Everything is doomed. But quietly, and to be fair, the investment manager hadn't put out any kind of RNS on this, but I saw that they'd completed the route of EMIC 1. So just to kind of wind back a gear, DGI9 is a investment trust. It's the worst performing investment trust of 2023. It was one of my ideas of 2024. It was possibly the worst investment trust of 2024, and that was through to a mixture of things. Not least of which it was uh, volcanoes. There was different things going on, and changing of the guard around the management, the replacement of the investment manager, um, a falling NAV, an unexplained and falling NAV. So yeah, I mean, this picture kind of does sum it up, that it's been in the wars, or not literally, but figuratively. So look, it didn't play out as I in as I believed it would. Um, I guess my perspective on it was, I looked at the assets. I looked at the assets, and the assets were actually really strong. I'll talk a little bit about those today, but it's I've written about them extensively, so I'd only really be reading out to you what you can already read. So, but yeah, what I wanted to focus in on was the 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 RNS that came out, which was this one. Um, so they're selling they're selling EMIC one. They've agreed a price of 42, which is 44.6 net of selling costs, which in turn is a 15% discount to the latest valuation as at the 30th of June. Now, as at the 30th of June, investors were told it was in our best interests not to be told what the NAV was. So it would appear that that best interest has now reversed, and it is in our best interests to be told that it was worth 49.6. And 49.6, if we let's just grab the this is my list of assets. So hence me releasing an article where I said question mark, question mark, question mark. And I filled these out. Now, I filled these out on the basis, I actually filled it out like this. Filled it out on the basis that I spotted that one of the assets was valued at 9% of the valuation was at one valuation method, another was at 3%, was valued at a different. So the shoe fitted that the valuation corresponded. So it was the level 1, 2, and 3, I think it was, that I spotted, corresponded to these values here. That was the FX rate at the end of June. So today's news of the 49.6, it actually is higher than I thought it was, or I estimated it was. It is actually 39.2. And they're selling it again at today's exchange rate at 33.5 million pounds. So there's a 0.6p loss to that, but what I think is very interesting is this and this. I mean, this one is trans-Indian Ocean. This one is transatlantic. This is pre-commercial. This is commercial. If anything, this valuation here gives us a very strong read across to this here. Very strong read across to this here. Now this 222.5 was now we have to kind of go back in time a little. Let's go into our time machine. So first thing that happened was they released this update. No, sorry, this update. And in this update, they told us that Aquacomms had grown in value from June to December and had grown by 12 million to 238 million. And that was due to, they'd done a valuation based on earnings, based upon Monte Carlo simulation. So this was the trading update. We then later, and it wasn't that long later, but then later got this, which was the annual report. And in this report, they dropped it by 16, sorry, is it 16? Yeah, no, 238 to 222 is 16 million. So this lower valuation, they said, was down to restrictions and limitations of cash flow and funding, but not a vast reduction. Even with some pretty harsh assumptions, and I make the point in my article that the weighted average discount rate of 13.6, and the majority of the assets are Arkea, and the assets of Arkea are contracted water meters, millions of, 5 million of, and television broadcasting, radio broadcasting, and satellite broadcasting, with some digital products sales thrown in. And the contracted income is into the billions. So the contracted income, I think, is 2.3 billion for Arkea. So 13.62, and I think it even hit 13.8 if I am not mistaken. If we, so the discount in June's update was then increased to a 13.8%. And the vast majority of the income is actually Arkea. So if we look at, I think it's this one here, we can see earnings of 93.5, earnings of 93.5, and that's EBITDA earnings, just to be clear. And Arkea is 76. So it's about 80% of the EBITDA earnings are subject to 13.8% discount rates, which clearly you make your own decision as to whether the 13.8 is a fair number. But to my mind, when you've got, essentially it's a very boring asset. It's pipe work. I mean, obviously it's not literally pipe work, it's metaphorical pipe work. It's the pipes of television and radio. But when the pipe work of National Grid, for example, is discounted at 5%, where do you get 13.8 from? I mean, that is just a colossal, unless, and they don't tell us the breakout of the DCF, but unless Arkea is on a discount of 5%, and then everything else is on a discount of 99.9999 recurring or something. I mean, whichever way you look at it, I mean, the discount rate is just mental. There's no other. I mean, it just doesn't make sense to me anyway. I mean, obviously discount rates are a way to value things, but ultimately you've got to make your own judgment call as to whether the like, just because somebody says, oh, I'm going to discount the future cash flows by 13.8 in a year's time, if the cash flows are still flowing in strongly and a year later they're still flowing in strongly, at some point in the world, the actuals are just massively exceeding the budgeted numbers. And when we look at Arqiva's performance, I mean, Arqiva is chucking off 300 million of operating cash flow, for example. It's delivering. I mean, obviously, it is very highly indebted. And when I say very highly indebted, I mean it's got a good chunk of leverage. But I mean, its interest payments are well covered. So you can kind of look at it like, oh, it's heavily indebted, as though that's kind of some, you know, at the end of the day, it's a way to fund infrastructure, and not dissimilar to the likes of Vodafone, which also has a lot of debt, and others. I can't speak for National Grid, but it wouldn't surprise me if they've got some level of leverage. That's just normal for this sort of asset. So you can see here 295 million more or less operating cash flow. That's up from 276 the year before. And obviously, there's we should see it in here somewhere. The interest payments made possibly are, well, I mean, gross debt is that, but just to kind of confuse things, there's a lot of things in here like shareholder loan notes that are um, kind of that they're not real debts, or at least these are debts to the owners of the company, and the majority owner of it, 51.75 economic interest, is DGI9. So it's kind of like it's heavily indebted, but the indebtedness is to yourself. So really, to make sense of the accounts, you've got to kind of look at them and say, well, let's just take out all of these shareholder loans. And I mean, this kind of tells you the scale of it, that there's 8.7 billion of liabilities, but 6.5 roughly is shareholder loans. Um, so really, yeah, I mean, I call them real liabilities. I mean, these are, and this includes things like lease liabilities and other things that, again, are, you can argue, they're not borrowing, they're lease liabilities, but the sort of liabilities of 2.3 billion, and you can see here, it's backed by assets of 3.2. So you're looking at 903 million, and 51.75 of that is 467 million. So in other words, when we look at this is the Arqiva valuation as at the end of December 23. This number here, 503, 3.2, is pretty. I mean, it corresponds to the net assets of the underlying holding pretty much. I mean, there's 30 million difference or something. So when we look at it today and say, well, what's this question mark value here? It's quite hard to think that this is vastly below um, what it was back then. I mean, like, we haven't stopped watching television, we haven't stopped listening to the radio. Those services haven't switched off. At least they hadn't when I turned the telly on this morning. Um, there's 5 million water meters across the UK. They're not going anywhere. We're not going to stop drinking water. I'm being facetious, but like, tell me where those 3.2 billion of assets as well. I mean, they're largely, it's land, it's masts and equipment, communications equipment. It's obviously the meters. Those assets are largely tangible assets. I mean, we're not talking 3.2 billion of intangible intellectual property or something. I mean, these are sort of real assets. So anyway, let's kind of get to the crux of this. So this valuation here, and we know that the whole thing now, in our best interests, we were told, don't worry about what the valuation is, but the overall NAV is 403. So when you piece together, and what I've done is I've added in a few lines here. So I've added in the Verne earning. So this Verne earning here is what kind of is essentially a debtor. This was because this was sold, hence the word sold. And what they did was they actually wrote down the 107 million that was owed, and they said, oh, we don't think we're going to recover about half of it. We're writing it off for prudence. Now, they don't give any real explanation as to why they've done that, and of course we don't know what's happened in the June update, because essentially this well, I mean, we know it hasn't been reversed, but when you look at the profitability of these assets, I mean, we can see it here that in the we haven't been given any update as well from the investment manager, or the previous investment manager, but they themselves are getting updates from Verne. But we know that in the last update, the profits at Verne Finland had doubled. Now there's 3 Vernes. Profits at UK Verne had doubled, and this one not quite doubled, but 60% increase in the Iceland Verne. And so look, Ardian, it's public record that Ardian have put $1.2 billion behind Verne to fund its growth. So would they have done that had it not had bright prospects? Would they have taken it on? Would they have paid 400 million for it, circa 400 million for it? You make your own judgment, but I struggle to think that 50% reduction won't at least partly reverse. So there's hidden value, and that's why I've put in a plus minus, because essentially it's not on the balance sheet, but I wanted it to be there because I think this write-off here, and this write-off 52.7, I struggle to believe that will remain in the full course of time. We then see the RCF. We see there's some net assets. Now, quite a bit of this is restricted cash, restricted because of EMIC. Now, again, the bit that's not sort of said here, but if you join the dots together, there's a load of restricted cash that's now going to be unrestricted, and there's some restricted cash relating to the RCF. So that's a positive. We also see that this will be due end of 2026. So this is kind of locked away. Let's call it locked away money. As I said, I mean, these are my estimates based upon the percentages disclosed in the 2024 interim update, which leaves us with question marks here and here and here. This isn't in the balance sheet, but I've added it in for visibility. That at the asset level, there's a vendor loan note. So I'm assuming that Arkea is worth at least 180 million, which again, seems reasonable. Seems reasonable to me. And I say, this is my estimate for end of December. That I'm assuming it's the vendor loan note's grown by another 6 million. It grew by 5 from here to here, so it's now 686. And that Arkea is at least covering that, leaving this question mark. So you'll notice I've filled out this number here. This is the number we know from the RNS. This is the valuation, and bear in mind that, I mean, back in earlier in 2023, this was valued at 17.5, and this is a data center, lowest latency in the UK, directly connected to the transatlantic cables running across to the US, directly connected to data cables running to continental Europe. So, like, it's not some quack asset that it's basically a business, Stellium, that own, or sorry, Stellium, that operate the data center, and DGI9 own the building that they lease to Stellium. So it's in a long term, and it's got RPI uplift as far as I can tell. So the revenue is RPI protected. So should it be worth 1/3 less? I tend to sort of say, well, on a good day, it would be worth at least 17.5. But I mean, let's go with the 12. But that 12 to me seems pretty nailed on. I mean, it would be, we're talking 35% off already. So, are we going to take another chunk of discount? I don't think we need to. This is a report, and it's in my article from the Times, saying that negotiations are for the sale of, and this is again taking a chunk, about 20% off the last disclosed value. And by the way, this was growing, the EBITDA was growing. So if we went to look to Elio, we would see that Elio, and it's not stellar growth, but the this EBITDA dropped because of investment into expansion into Cork, but the underlying revenue is growing, cash flow is growing, so all positive, positive direction. If we move to this now is then the key question. I mean, is it fair to read across from this valuation to this one? I would argue yes. I believe it is. So, I mean, if we said, fair enough, let's do it. What we're saying is, the same sort of discount, 85%, so 15% discount to NAV, and the NAV is that, gives us that 189. Now, this bit by here, by the way, this MIA, missing in action. So in their infinite wisdom, the previous investment manager decided to write off 283 million at the end of December, and part of that missing in action, this value here was for example, this was written down by 16, and this was written down a bit, and so there was a number of, this was written down a bit, so there was a number of write downs that that happened to cause it to go from £1.7, I think it was, to 80p, and then we see then another missing in action, and this time we don't know what is missing in action, hence the question marks. But that sort of takes you from 80p or 79.3 to 46.6p. So we've got two missing in action valuation drops. Again, not really on any negative news, other than obviously they sold Verne at a slight loss and took a hit. This 52 is part of that missing in action number. Anyway, so if we said, well, yeah, let's take that 189 as a fair read across. And actually, the other thing I'll just quickly say is I do talk about this in the article, that if we look at Aquacoms, and somebody excuse me, pointed out, oh well, their profits dropped, their EBITDA fell, substantially fell by about 20%. You can see it here. They do explain this. The revenue grew. Importantly, cash flow from operations grew by quite a bit, but you can see it here. I mean, this capex year-to-year change is very high, and they say here a bit to decrease 19% because of the planned addition of headcount for expansion into new geographies, along with temporary overlapping costs due to the outsourced. as well as the launch of this cable where they incurred costs up front. So the underlying EBITDA, obviously we don't know what these temporary and one-off costs were. They don't disclose that to us, presumably in our best interests. But they do say that ramp up will occur, customer demand remains strong, uh, capacity demand continues to grow at very, very high rates. Now, um, basic economics is that you've got supply and demand, and that as the demand curve moves out, prices go up. That's that's just basic economics. I mean, one of the readers said, "Oh well, there's a new technology that has increased the supply. That you can send data, 10 times more data at half the price, at a fraction of the price, and that's why profits have fallen. That have plummeted." Um, so, I mean, first of all, the profits have we were given an explanation why the profits fell. Whether you believe it or not, I mean, it's entirely up to you. But it to me, it's very clear that there are one-off factors, and the underlying EBITDA, if you actually strip out the exceptional costs, you're looking at least the same EBITDA, if not a higher EBITDA underlying, in my opinion. That's only my opinion. Um, but common sense to me tells me that, because I did ask the reader, I said, well, what technology have they introduced? What is this new way to send data at a fraction of the cost? Be able to send more and more data through the same pipes, with and they said, oh, well, I don't know. I don't know what technology, but there must be some technology. I was like, okay. So you don't know that there's a way that they've somehow, that rates have fallen. I mean, generally, if demand is strong, that puts upward pressure on pricing, not downward pressure on pricing. Obviously, yes, if supply has increased, that puts downward pressure on pricing. But I mean, yes, there is competition. There are other cables, and in my article, I say, well, when you look at the other cables and the other cable operators, which is, where is it, up here with a bit with uh, um, Aquacoms, we see that somewhere in here. There's a lot of detail. Yeah, so the read across from Sienna, presuming that's how you pronounce it, was that they've doubled their share price in 2024. That we've also got Lumen that operates a subsea cable as well, tripled or more than tripled actually. So are they suffering from this imaginary supply shock, or are they benefiting from an increased demand curve? I'll leave you to conclude which one you think that is the explanation. But anyway, I think there's a lot of reasons why even that discount is a bit like you could imagine that it could sell for more than 15% off. But let's go with that number for now. So what we're talking about then is like sold, everything's sold, or going to be sold. So this kind of adds up to 279.6. So let's say 280 million. So what that does is, we've now got that 35.1 million, plus the 279.6 cash pile. Okay. Um, Obviously this remains, but it's sort of untouchable. I mean, here I'd sort of just call out that there's probably some value or some reduction, whichever way you want to look at it, there and there. But even if we don't do and so we've still got this RCF, but let's pay that off. Okay, so that's now zero. And of course, up here we've got the vendor loan note. So we pay that off, and that's now zero. Okay, so we're left with Arqiva that we think is worth at least 186. And then we've got this Vern earning and we've got this. So, I mean, at the very least, on today's share price, which is it's up quite a bit, but it's 172 million. So what we're saying is that this, based upon selling these assets and paying off all debts, basically has whatever Arqiva is worth, okay, plus 75 million of cash. So really, when you kind of look at it that way, plus this earning here of earn. So when you look at it that way, 130 million here minus the 172. So what we're saying is let's just take so we'll take that figure plus that figure minus the 172, leaves you with 42 million. So what you've got to ask yourself is Arqiva, that was worth 500 million back at the end of last year, 12 months ago, and is now debt free, is Arqiva worth you know more than 42 million? Because for if it's 500 million, if it's 500 million, that oh sorry, let's start again. We want to do that. Oopsie. So it's on a 91.6% discount to its asset, and it's that before that additional earning. I mean, it does assume that this earning happens, and if it doesn't, then you're looking at, well, worst case scenario would be that you have to kill that off. You don't get it, and you're paying 96.6 million for Arqiva. And if that's the case, then you've got to just be happy that getting an Arqiva at 80% discount, not 91, is acceptable to you. But if we get that full 107 million back, probably have to do it that way round, I think. Yeah. So you're getting paid 10 million to get Arqiva for free. Okay. So and of course this depends on this valuation here, which may or may not be the case. But I mean, let's sell it at half price. Okay. So it drops to 111 from 189. So it's 78 million knocked off the valuation. So what you've got to ask yourself, and let's assume that 107 doesn't happen either, what you've got to ask yourself is, well, am I happy? Let's just change that there. Am I happy to have worst case scenario? And this is where we're selling Aquacom's at half price for no particularly good reason, as far as I can see. Am I happy to buy Arqiva at 2/3 off its last proper valuation? When the 2024 accounts show a lot of strength, I think it's fair to say that when we go back and look at the history of Arqiva, I mean, we see that it's backed by assets. So even if you just asset strip the whole jolly thing, you'd get back in tangible assets. I believe you'd get back the money. You've got a strongly growing smart meters business that Ofwat have said that there's 10 million smart meters that could be rolled out with that's worth 1.5. So I mean, at the moment today, there's the smart meters business is worth I've said circa 200. It was 198.7. So you'll allow me the 1.3 maybe. But this is growing this grew 5% last year on the last update. It could potentially grow to 600. And if it did, it would be bigger than the media, it would be bigger than the television, radio and broadcasting, satellite, to 100 countries business. So another sort of point to make is that this is, going back into the annals of time, that 297 million operating cash flow is not vastly different to where it was in 2017 when it sold its telecoms business for £2 billion, and where Arkea was going to be IPO'd at 6 billion. So the net assets at 903 million and 51.75 is 467. I mean, could be just vastly undercooking. I mean, normally for a business that's got contractual assets stretching forward several decades, that has a very strong brand name, that is a world-class business, arguably. I mean, would it sell for 33 or 67% off, 80% off, 90% off, or you can see I've kind of come up with a range of outcomes there, but whichever way you look at this, I just think that it's very, very. I mean, this is just my own personal opinion. This is not investment advice. It's just an opinion. But I just look at the numbers, and I just really, really struggle to see how this 172 is where it will end up. Let me put it that way. Anyway, that's Oak Bloke. Just kind of giving my twopence, twopenneth worth. Hope that's been useful to you. This is just my opinion. I don't, obviously I don't know these things for sure, but I'm just looking at the numbers, and the numbers look good. Okay, cheerio for now.